If I told you there is a Canadian company that makes pressure-treated wood, utility poles, railway ties, and lumber, and that over the past 20 years it turned $500 into approximately $46,000 in total return, including dividends, while the S&P 500 produced approximately $2,400 from the same $500 over the same period. Would you have heard of it? Almost certainly not, because nobody talks about it. It does not make the Motley Fool's top 10 list. Financial media ignores it. Most Canadian dividend investors have never seen the ticker. Because when you scan a list of dividend stocks and you see pressure-treated wood products, you scroll past it. That company is Stella-Jones, ticker SJ on the TSX. 18 consecutive years of dividend increases. A payout ratio of approximately 15%, one of the lowest on the entire exchange. A 5-year dividend growth rate of approximately 13.6% annually. And a business model tied directly to one of the most powerful infrastructure themes in Canada: grid electrification. This video is about 5 Canadian dividend stocks that nobody talks about, not because they are small or obscure or risky, because the financial media has a bias toward the familiar: banks, pipelines, utilities, and the truly excellent businesses hiding in unglamorous sectors get systematically ignored. All 5 have track records that the famous names would envy. All 5 are still being overlooked, and all 5 have a specific reason they are hidden in plain sight. Before the 5 stocks, the connecting thread. Every Canadian dividend investor who uses yield as their primary filter will miss every single stock in this video, because all 5 have current yields between approximately 1% and 4.5%. At the lower end or well below what income-focused investors typically screen for. The financial media covers dividend stocks that yield 5%, 6%, 7%, because those numbers get clicks. But current yield is a snapshot of a single moment. It tells you what you earn today on today's price. It tells you nothing about what you will earn in 5 years as the dividend grows, or what the underlying business is worth. Here is the concept that changes the filter entirely: yield on cost. Yield on cost is what you actually earn on your original investment, after years of dividend growth. If you bought Toromont 10 years ago, and the dividend has grown at 11% annually, your yield on cost today is dramatically higher than the current 1% yield new buyers see. The investor who bought Toromont a decade ago is earning a much higher effective yield on their original investment than the 1% headline suggests. Every stock in this video has a low current yield. Every stock has a high dividend growth rate, and every stock has been compounding that growth for long enough that long-term holders are earning yields on cost that would make the famous high yielders look modest. Current yield is the price of admission. Dividend growth rate is the compounding engine. The stocks in this video have the engine running at full speed. They just do not advertise it with a high headline number. Toromont is Canada's largest Caterpillar equipment dealer, distributing bulldozers, excavators, mining equipment, and industrial engines across eastern Canada and the eastern U.S. seaboard. It also runs CMCO, which designs and installs industrial and recreational refrigeration systems. Think ice rinks, food processing facilities, cold storage. And increasingly, through its AVL subsidiary, Toromont is building power infrastructure for data centers. That last point is new and significant. The AI infrastructure build-out requires massive amounts of power, and companies that can supply, service, and maintain the industrial power systems behind data centers are in structurally growing demand. Toromont is quietly positioning itself as an infrastructure partner to the AI economy while most investors still see it as a Caterpillar dealership. The dividend track record. Toromont has paid dividends continuously for over 35 years. It has raised its dividend for 14-plus consecutive years. The most recent raise, 7.7% in April 2026, taking the quarterly dividend from 52 cents to 56 cents per share. The raise before that, 11.6% in February 2025. 5-year dividend growth rate, approximately 11.3% annually. The payout ratio is approximately 32%, meaning Toromont retains approximately 2/3 of its earnings for reinvestment and future dividend growth. This is a company that is not stretching to pay its dividend. It is paying less than 1/3 of what it earns. Why nobody talks about it? A current yield of approximately 1% filters it out of every income investor's screen immediately. The business description. Caterpillar equipment dealer. Sounds like a cyclical industrial business with no moat. Neither description captures the reality. A company with 35 years of uninterrupted dividends. A deeply embedded service business that generates recurring revenue through parts and maintenance, and a new growth vector in data center power infrastructure. The risk. Toromont is tied to construction and mining activity in eastern Canada. In a severe recession, equipment sales slow, customers delay purchases, and revenue contracts. The service business provides some stability, but cannot fully offset a deep cycle downturn. This is not a utility. The dividend has been sustained through cycles, but investors should understand the cyclical exposure. Stella-Jones is North America's leading producer of pressure-treated wood products, specifically utility poles, railway ties, and residential lumber. If you have ever looked at the wooden poles holding power lines along a highway, there is a good chance Stella-Jones made them. That might sound like a commodity business with no competitive advantage. It is not. Pressure-treated utility poles are subject to strict utility-grade standards. They require long-term supplier relationships because utilities need reliable, consistent supply across geographic regions. Stella-Jones has built dominant market share in Canada and significant U.S. market share through decades of capacity investment and customer relationship development. New competitors do not enter this market easily. The capital requirements, environmental permitting for treatment facilities, and long-standing customer relationships create genuine barriers. The electrification thesis. Every electric vehicle charger installed requires grid infrastructure, often including new or upgraded utility poles. Every solar panel and wind turbine connected to the grid runs through utility pole infrastructure. Storm damage, which has been increasing with more severe weather events, requires immediate pole replacement, and grid modernization programs across North America are driving sustained demand for new infrastructure. Stella-Jones is a direct beneficiary of the electrification of everything. It just does not market itself that way. The dividend track record. 18 consecutive years of dividend increases. A 5-year dividend growth rate of approximately 13.6% annually. A payout ratio of approximately 15%, among the lowest on the TSX. When a company earns significant profit and returns only 15% of it as dividends, it has an exceptional runway to keep raising that dividend. The 13.6% growth rate at a 15% payout ratio is a signal of extraordinary dividend sustainability. Why nobody talks about it? Pressure-treated wood. Materials sector. The name does not appear on any financial media's list. It does not appear in any conversation about electrification or infrastructure. The sector label buries it. The low yield, approximately 1.5% to 2.0%, filters it out. Alimentation Couche-Tard operates more than 17,000 convenience stores globally, primarily under the Circle K banner, across North America, Europe, and increasingly Asia. It is the largest independent convenience store operator in the world. Most Canadians know Circle K. Almost none of them think of Circle K as a dividend stock, because at 1.1% to 1.2% yield, it does not look like one. The serial acquirer model, Couche-Tard's business model is built on disciplined acquisitions, buying convenience store chains, integrating them efficiently, and improving operating margins through scale and process improvement. It has executed this playbook consistently for over 2 decades, acquiring stations and chains across the U.S., Scandinavia, Ireland, Hong Kong, and beyond. The discipline is key. It does not overpay. Management has walked away from deals when prices became irrational. The dividend track record: 14 consecutive years of dividend increases. A 5-year dividend growth CAGR that has exceeded 20% in some periods. A payout ratio of approximately 18%, extraordinarily low. A trailing PE of approximately 19 times, reasonable for a company with this growth record. The dividend is a signal of discipline. The company could pay much more. It chooses to retain capital for acquisitions and buybacks instead. The real return driver, Couche-Tard, is not a pure dividend income stock. It is a total return compounder that also pays a growing dividend. The combination of earnings growth through acquisitions, margin improvement, buybacks, and a growing dividend has produced one of the strongest long-term total return records on the TSX. Canadian investors who screen it out because of the 1.2% yield have missed one of the greatest compounders their own market has produced. Why nobody talks about it as a dividend stock? The yield is too low for income investors. It is perceived as a growth stock, which it is, but growth stocks can also be dividend growers. The Quebec French language origin of the company means it receives less English-language financial media coverage than Ontario-headquartered companies of equivalent size. And the business, convenience stores and fuel, does not inspire the same conversation as pipeline infrastructure or bank dividends. Canadian Natural Resources is Canada's largest oil and gas producer, operating oil sands, conventional heavy oil, and natural gas assets primarily in Alberta. It produces approximately 1.3 to 1.4 million barrels of oil equivalent per day, and has done so with increasing efficiency over the past decade as it optimized its oil sands operations. The dividend track record: 26 consecutive years of dividend increases. Through the 2014 to 2016 oil price collapse, the 2020 COVID crash, when oil briefly traded at negative prices, and every other commodity disruption in between. Current quarterly dividend: $0.625 per share. Current yield: approximately 4.0% to 4.5%. Payout ratio: approximately 51% on earnings, with cash flow coverage at approximately 80%. The 26-year streak through commodity cycles is the specific credential that sets CNQ apart from other energy companies. It has not just survived difficult markets, it has grown the dividend through them. The integrated, long-life nature of its oil sands operations gives it lower sustaining capital requirements than conventional oil producers, translating to more durable free cash flow even in down markets. The shareholder return machine, CNQ, recently announced $1.29 billion in buybacks alongside strong production guidance for increased output in 2026. It is simultaneously paying a growing dividend and aggressively buying back shares, reducing the share count and increasing per-share earnings for remaining shareholders. Few Canadian companies combine a 26-year dividend growth streak with this level of buyback aggression. Why it is overlooked relative to Enbridge and TC Energy. The energy sector narrative in Canada is dominated by pipelines. Enbridge and TC Energy get the majority of dividend-focused energy coverage because their regulated business models make them feel more utility-like. CNQ's oil sands exposure carries ESG perception headwinds, and the commodity cyclicality of oil prices makes some income investors uncomfortable, even though the dividend track record clearly demonstrates management's ability to sustain and grow through cycles. The honest risk, CNQ, is oil. Long-term energy transition risk is real. The oil sands are high cost relative to Middle East conventional production. These are genuine considerations, not dismissible. But the 26-year dividend growth record through every cycle since 1999 is a specific, documented track record of dividend resilience that deserves recognition. Richelieu Hardware distributes specialty hardware, decorative hardware, and finishing products to kitchen and bath cabinet manufacturers, furniture makers, and renovation contractors across North America. If a cabinet maker needs hinges, drawer slides, handles, knobs, finishing products, or installation hardware, Richelieu is likely their supplier. This sounds like a middleman business with no competitive advantage. It is not. The switching cost is the moat. Cabinet manufacturers build their entire production process around a supplier's product catalog, delivery reliability, and technical support. Richelieu maintains tens of thousands of SKUs, provides same-day or next-day delivery to manufacturer specifications, and offers technical product knowledge that competitors cannot easily replicate. Customers who switch suppliers face operational disruption, retraining, and product compatibility issues. They do not switch often. The dividend track record: 15-plus consecutive years of dividend increases. The most recent raise, 15% in January 2026. A payout ratio of approximately 30% to 35%. Conservative and sustainable. A current yield of approximately 1.2% to 1.5%. A 15% dividend raise signals significant management confidence in the earnings outlook. It is not a token increase, it is a statement. Why nobody talks about it? Richelieu Hardware sounds like a hardware store. Most Canadians assume it is in the same category as Home Depot or Rona. It is not. It is a B2B specialty distributor to manufacturers. The distinction is invisible from the company name. No financial media covers it. No retail investor knows the ticker. It has approximately zero social media presence in the investment community. The business is also tied to the renovation and housing construction cycle, which means it is sensitive to housing market conditions. In a slow housing market, cabinet makers order less, and Richelieu's revenue softens. This is the primary cyclical risk to understand. 5 Canadian dividend stocks that nobody talks about. Toromont, 35 years of uninterrupted dividends, growing at 11% annually, quietly pivoting into data center power infrastructure. Stella-Jones, 18 consecutive years of increases at 13.6% annual growth, 15% payout ratio. Utility poles connecting Canada's electrification future. Alimentation Couche-Tard, 14 years of increases, 20% plus growth CAGR. The greatest serial acquirer in Canadian history, hiding behind a convenience store description. Canadian Natural Resources, 26 consecutive years of dividend increases through every oil crash of the last quarter century, combined with one of the most aggressive buyback programs in Canada. Richelieu Hardware, 15 years of increases, 15% raise, In January 2026, a switching cost moat nobody has ever written a financial media article about. The connecting thread is the yield filter. Every single one of these companies was invisible to the income investor screening for 5% plus yield. Every single one has built a dividend track record that the famous names would struggle to match. The yield is what gets you into a room. The dividend growth rate is what makes you wealthy inside it. The most famous Canadian dividend stocks are famous because they are familiar, not because they are the best. The best are often hiding in sectors nobody glamorizes, paying yields nobody screenshots, growing dividends nobody notices until a decade later. Now you know where to look.